Good day. This is Jeffrey Cleveland from the Payden Economics Team with another economic review and outlook, this time for the month of November 2020. If we had to summarize the review and outlook in one sentence or one line, it would be a much faster than expected but highly uneven recovery is underway. And welcome in once again, ladies and gentlemen, still here in the home office in the Los Angeles area, and we're showing you on this chart U.S. real GDP on the green line, potential GDP, an estimate of potential output, the blue line. This is in trillions, and we're showing you the last 2 decades. And there are really 2 things I want you to notice on this chart. First and foremost, the far right-hand side of the chart, that very sharp V-shaped recovery that we are seeing in U.S. GDP through the third quarter. Very good news, very welcome development, a much faster recovery than even the most optimistic forecasters had expected just a few months ago. That still leaves U.S. GDP roughly 3.5 percentage points shy of pre-recession levels and about 3.6% below potential output. But that brings me to the second thing I want you to take note of on this particular chart, and it's right here, sort of right below, right there. That is the post-2008 period. You see GDP, the green line, fall, not quite as steeply as what we witnessed here in the COVID recession, but it took years for the green line to recover and get back to potential GDP, for us to live up to our potential, ladies and gentlemen. We didn't get there until 2018. So that's why that period after '08 led to such high, lingering high unemployment, sluggish economic growth, low inflation. That is not, and it's very good news, what we are experiencing here in 2020. We are experiencing a very sharp snapback in activity. It's not 2008, and I think that's important to recognize. It is, however, a very unique and uneven recovery. Here we're showing you consumer spending split into goods and services. And so on the left-hand side of the chart, you see goods spending in 2 eras. The current era, January 2020 through September 2020, that's your green line, and the the 2008 recession, rather. So that's your blue line. So you can see on the left-hand side of this chart a sharp downturn during the shutdowns, but then a really sharp V-shape. In fact, this is more of a checkmark shape recovery in goods spending here in 2020, your green line. Very impressive, especially relative to what we saw after 2008, where it took 3 years for goods spending to recover. This time around, spending on everything from autos to washing machines to homes all picked up relative to pre-COVID levels. I myself I've been to Home Depot more times in the last month than I think in the last 3 decades combined. So you're definitely seeing that show up in consumer spending on goods. Go to the right-hand side of this chart, though, and I think you see why this recession is unique. It is a services-driven downturn. Services spending there in 2020, the green line still depressed, down about 6% relative to pre-COVID levels. And this is in sharp contrast to what we saw even after 2008, where there was a little bit of a lull in services spending in that era, but then services spending took off. It never contracted after 2008. But it should be no surprise. Services are everything from the haircut that I just got last week to medical services, to travel services. So that type of spending due to the pandemic remains depressed. However, I will say, looking out into 2021, I think what we expect here is a little bit of a slowdown in the goods side. So spending on autos and housing, that should taper off a little bit. And it will be services spending that will come back pretty sharply, I think, in 2021 over the full course of the year, especially if recent headlines are the sign of what's to come in terms of possible vaccines. That will only help the services part of the economy recover more quickly. We're seeing a very sharp snapback, or we have seen a very sharp snapback in the economic data around the world as well. Just take note of this. The German and the Eurozone as a whole, and the French GDP declines that we saw, the orange bars in the second quarter, and then the subsequent increases in the green lines in the third quarter. So you've pretty sharp declines in Q2 and then almost proportional rebounds in Q3. So sharp recoveries in the economic data through Q3, also around the world, not just the US. This is all good for the unemployment rate. This is the U.S. unemployment rate and the number of people receiving unemployment insurance benefits in the U.S. You see those sharp declines in the last couple of months. The U.S. unemployment rate is now below 7%. It's at 6.9% as of October, which is great news. It's a sharper than expected decline. We think it's quite likely that we'll get to the end of 2021 and we'll see the unemployment rate below 5%. So that is great news, and more progress on this front in the year ahead. Now, there are a lot of question marks. There's great uncertainty for the next, I would say, 2 to 3 months, given the resurgence of the virus in the US and Europe. I want to draw your attention in particular on this chart, which is tabulating the open table data for seated diners at restaurants around the world. I'll draw your attention to that red line. That's the German dining data. Germany, of course, during the lockdowns in March and April, dining out fell 100% during that period, rebounded and was above the pre-COVID levels for much of the summer, but we've seen a sharp deceleration in German dining given the resurgence in the virus and renewed lockdown measures. We expect a similar pattern in the chart. We'll probably repeat for the UK. Now, I'm not sure we'll see the same decline in the US data. You'll notice the US is that orange line on the chart. US dining out never really recovered. I can tell you here in California, we still cannot go out to restaurants and have indoor dining, so it hasn't really rebounded back to pre-COVID levels. So we probably see localized lockdowns here in the US, but not a nationwide lockdown. So maybe the US fares better in the next couple of months on this measure. The other thing that the US has going for it, which I think will help bolster the economy over the next couple of months, is a huge amount of personal savings. So this is the aggregate savings pool, if you will, for the U.S. consumer. You can see the September reading on this, over $1 trillion there in savings. Really important to compare it to the February levels. So we've seen a huge increase in the savings buffer that the U.S. consumer has. And I think this is going to be really important over the next couple of months, but also into 2020. So here is the summary of our outlook. The thing to notice on here is to focus on the third column there, the Payden 2021 forecast. We're trying to leave 2020 behind. We're going to forget about 2020, jump into 2021. So in terms of growth, as I said, I think we do have a lot of pent-up demand. We will see some progress on the virus front, and that should help services, the services component in the U.S. economy recover. So we're expecting a pretty nice GDP growth figure for 2021, 4.5% for the full year. That should help bring the unemployment rate down from 6.9% right now down to 4.9% by the end of 2021, which is great news. At the same time, we don't see a lot of inflation pressure or inflation risk in the U.S. economy, so we'll still be probably below 2% on inflation by the end of next year, and that will keep the Fed firmly at zero on the Fed funds rate. So that is the economic review and outlook for November 2020. A much faster than expected recovery is underway. It's highly uneven. There's a lot of uncertainty, but we'll provide you another update in December. Thanks, everyone.